National headlines are saying that the markets are cooling. Cancellations are rising. Delistings are up nearly 50%. But is the Metro Detroit market crashing too? Or is this just the pain of a recalibration? So I want to break it down today with Eric. If we talk about the national market, it's not crashing by any means. We're not looking at a 2008 scenario. However, it has cooled dramatically. US inventory is up 20% year over year. That's over 1.5 million homes for sale right now. Now, the interesting thing is that the home prices are still rising. So we're still seeing appreciation. But for people that are listing, we're seeing a major uptick in canceled contracts. Canceled contracts and expired listings are surging. Also seeing, with those canceled contracts, buyers are getting the property under contract and then they're walking away. And as far as those withdrawn and expired, those delistings, they're up nearly 50%, meaning the sellers are quitting because they can't get the price that they want or they can't handle the emotional roller coaster. So it's not a crash, it's just fatigue. Buyers are fed up, sellers are burned out, and expectations are honestly colliding with today's reality. So I think our only saving grace, because the inventory has gone up so much, is the rates pulling down. And that's why I'm going to look to my friend Eric to give us some projections. And hopefully he's going to tell us that rates are coming down to 4.5 next month.
I'd love if they did. I think realistically, yeah, we're probably not going to see 4.5 for quite a while still. However, there was a little relief. The big news that's came out over the last week was the jobs report that came out through the Bureau of Labor Statistics, much, much weaker than expected. This is something in our industry we've seen for a while, and it led to the firing of the head of the BLS, which I don't like the way that the administration approached it, saying that it was political. I think it was more like, honestly, lack of doing her job. Going back over a year, if you had looked at what was getting reported by the BLS, it was extremely positive jobs numbers, with then later revisions removing a lot of those jobs from the market. If you look at last year, over 800,000 jobs got removed from the market that they had previously reported had been created. That was during the election over through the fall. And then a similar thing happened just this month, and that's what led to all this, where the BLS was reporting really positive job growth, and then went back and basically wiped it all out and said, nope, we didn't really get any jobs. Sorry, we made a mistake. That led to the firing of the BLS. That in turn has led to a significant drop in rates. And what that means is, hey, the economy's not doing nearly as well as what had been being reported in the news. And that again is honestly going to be the relief that we will see with rates. Now, rates are down about a quarter point since that happened. And really the projections in the market are that the Fed is expected to cut rates in September by a quarter point right now. If we got some additional, let's say, negative news, positive for interest rates, but negative news in the economy, potentially it could even be more than that. Yeah, really, that is the relief that we see coming, is that potentially we got lower rates on the horizon. I don't see it happening without some more poor economic news, but the feeling in our industry is that's on its way.
That's good. Yeah, I mean, I've talked to a couple people who said, you know what, I think fall is going to be a good market. I think the rates will pull down, and nobody knows. Nobody has a crystal ball. I think everyone's trying to be optimistic at this point. I've got 9 listings myself right now. 3 of them we penned it in the first 3 days on market, the first weekend on market, but that was because we did strategic pricing. So basically the premise is, there are buyers in the market, but they're all going to chase the most aggressively priced listings. So what we did was we priced under market value. All the buyers chased that listing, and then they the buyers bid it back up to market value. And then we got our goodies like, all cash offers, appraisal guarantees, pass fail inspection. I think that's the real strategy right now for sellers is, take all that historical data from the last 12 months and subtract 5% from that. And that should be your pricing. And people will often ask me, well, what happens if only one offer comes in and it doesn't get bid up? And my response is always, well, then the market just told you that that's all your house was ever worth, despite historical data. I mean, market will speak to us all the time. Let's go over Metro Detroit stats. I mean, it's holding strong for now. The June 2025 data, inventory is way up. We got 20,000 homes for sale in just Metro Detroit. That's 21% year over year. We have 3,200 condos for sale. 26% year over year. I've got a condo listing right now that just won't move, partly in part because of the HOA. The HOA fee being almost $600 a month, combined with $14,000 a year taxes. It's tough for condos right now. But that combined inventory, if you talk about houses and condos, that's over 23,000, and that's the most available inventory that we have seen in 5 years. Just to put that in perspective, we have not seen that many homes for sale in Metro Detroit in 5 years. So there is a shift happening right now. We're heading pretty quickly towards at least a balanced market, if not a buyer's market. And I hate to even bring that up, but that month's supply of inventory is creeping higher and higher and higher and higher. And pretty soon, though, more sellers than there are buyers. And that's going to create that buyer's market where buyers are calling the shots. So again, it's all going to come down to the rate. I mean, and again, the homes are moving, but only if they're priced right. Only if they're priced right. The buyers that are in the market are still chasing the most aggressively priced listings. So Eric, I mean, what are you seeing with, or why do you think this inventory is growing? What are your thoughts there?
I think, like you said, I think it's a lot of buyer fatigue, and it's again setting realistic expectations. Honestly, in the last week, I've had two buyers pull out of deals because they felt like they were paying a premium price for the house. They get into inspection, they find some issues with the house where they, didn't feel like for a premium priced house that there should be these issues with it. Two deals, one on appraisal, the other on the inspection. And yeah, I think the buyer's expectation right now is that if you're still asking me to pay a premium price, this thing better be move-in ready. And that might not have they don't want to have to do anything to it. Because again, they're not only paying a premium price in the market, which is the result of the last year or two of really high home prices moving up, but also combine that with interest rates, and buyers are a little less apt to just jump at the first thing on the market. They're certainly saying, hey, I've waited this long, I can wait a little longer.
I couldn't agree more. Yeah, I think the buyers are so fatigued, they're so frustrated. And then I think we're seeing that inventory finally shoot up because of debt. Sellers that were hanging on to that 2 or 3% interest rate that they got during the pandemic, they're having to list their homes now because they've racked up so much debt. Do you think that might be true as well?
100%. If you look at credit card related debt, right now we're still at the highest we've been in the US really ever. I mean, even back to the big recession, back 15 years ago. It's got a little over 15 years ago now. Consumer debt is extremely high. I've had a number of people in the last week reach out to me about doing cash out refinances. Or if you also look from a seller's perspective, hey, maybe I need a new roof. I need to figure out a way to do this and I don't want to pay for it. So listings are moving up because people don't want to have to pay for something that they don't plan on being in forever. And again, it's just all kind of a snowball. And to kind of both of our comments earlier, hopefully lower interest rates will take care of this. But for people that think it's going to be down in the 4 or 5%, I know Trump has said publicly that that's really like to see it. Unfortunately, he doesn't get all the say in that. And quite honestly, that would cause a huge disruption, not only in the housing market, but in the bond market if rates were to fall that quickly. So I think what we're going to see is a gentle easing over the next few years. I think they're going to come down. But as far as like a type of drop where all of a sudden they drop 1-2% in a very short time frame. I think that's probably unrealistic expectations. But yeah, absolutely. I mean, the economy, I feel like with consumer debt being so high and interest rates still being there, there's definitely cracks in there. Employers are not hiring at the pace that they were a few years ago, and there's really just a real pullback in the entire economy.
Yeah, yeah, 1,000%. I want to go over our our local MLS. It's Real Comp. It's Southeast Michigan, Metro Detroit. The last 7 days, 3,500 new listings. Now, just to put that in perspective, that number for the past 7 days has been less than 2,000. For going back the last few years. Only 2,000 or less new listings every 7 days, and now it's at 3,500. Now, out of that number, 2,500 reduced price. So 71% of new listings had a price drop. That is staggering. Now, check this out. 2,417 went pending, meaning 217 people accepted an offer on their home, but 2,473 reduce their price. So the price reductions outweigh the accepted offers. That is not a number that we ever want to see. That's pretty crazy. And as far as unconditional withdrawals, there's almost 500 unconditional withdrawals. There's 610 expired listings. So that gap between listing price and reality is really starting to widen. The price reductions are pretty much matching or exceeding pending contracts. And these sellers that are testing high, they're having to pull back when the reality hits. So I'll kind of leave you with this. Like, if rates dip even slightly, buyers will jump back in. But sellers, they gotta ditch the 2021 like thinking, and they gotta play to today's buyers. And we gotta act before the next rate drop surge. Everyone's tired, everyone's uncertain. But these are the exact conditions where the smart moves happen. There's a lot of opportunity for buyers, and there's a lot of opportunity for sellers if they play the game right. Eric, any final words?
I couldn't agree more. If there's, again, I notice that you got to remember buyers that are still in the market right now are shooting for a deal. So if you shoot high, you reduce your price down to where you think it is. Well, the buyer's mentality on that is okay, and it's sat. So now I can offer less than that. So you're better off with that lower price, getting it sold quickly, and is where the buyer still has a mentality that this is a hot commodity, and I need to make sure that I'm making a premium offer coming in, not going in trying to lowball on top of the already reduced price.
That's the play right now. Thanks for watching. We'll see you in 2 weeks.
Sounds good.